Hi and welcome to our analysis of Navin Fluorine International Limited, a leading player in the Indian specialty chemicals industry. To drive future growth, the company invested 2,200 crore rupees in new greenfield projects for its specialty, CDMO, and HPP businesses. This investment comes alongside impressive financial performance, with its stock price soaring over 35% annually for the last 5 years and revenue doubling over the same period. In this video, we will delve into Navin Fluorine's business segments, revenue segments, shareholding, management, cost structure, financials and management outlook for the future. Let's get started on the stock analysis of Navin Fluorine International Limited. But before that, let me introduce ourselves. We are PA Wealth, an investment services group. We offer stocks PMS, mutual funds, alternative investment funds, insurance, and startup investments. Every week, we upload research videos on different companies, mutual funds, and financial topics. Stay ahead of the curve with the latest trends and insights by subscribing to our channel and clicking the bell icon to get notified about potential multi-bagger stocks. Let us provide a brief introduction to Navin Fluorine. Founded in 1967, Navin Fluorine International is India's biggest maker of specialty fluorochemicals. They are part of the Padmanabh Mafatlal Group and manage one of India's largest integrated fluorochemical facilities in Surat and Dahej, Gujarat, and Dewas, Madhya Pradesh. NFIL specializes in fluorination and synthesis, making it a significant supplier of intermediate chemicals to the pharmaceutical and agricultural sectors. Their products are sold both domestically and worldwide, having operations in Europe, the United States, Southeast Asia, and the Middle East. Now, let's look at the business segments of Navin Fluorine. First, Contract Development and Manufacturing Organization, CDMO. This is the company's fastest growing segment. It manufactures chemicals for different companies to assist them to design and manufacture products. The company has gained from a trend in which pharmaceutical corporations shift some production to India rather than China. Navin Fluorine focuses on complex intermediate chemicals rather than finished drugs and is working to establish confidence with potential customers by having their facilities upgraded to meet the guidelines or standards required by international producers. Second, high-performance products. This segment includes refrigerants, used in air conditioners and refrigerators, and inorganic fluorides, used in various industries. Navin Fluorine is a major producer of these products in India and they were the first Indian company to produce both R22 refrigerant gas and HFO, hydrofluoroolefin, refrigerant. Third, specialty chemicals. This segment focuses on developing and manufacturing chemicals for use in crop science and performance materials. They are targeting partnerships with companies that are innovating in these areas. The specialty chemicals market is expected to grow rapidly in India, and Navin Fluorine believes they are well positioned to be a leading supplier. Now, let's discuss the revenue segments of Navin Fluorine. First, vertical-wise revenue. High-performance products is the largest segment of the company's revenue, accounting for 49.34% for the fourth quarter of FY24. This is followed by the specialty chemicals segment, which accounts for 42.69% of the total revenue. CDMO segment accounts for 7.97%. Second, geography-wise revenue. In the fourth quarter of FY24, Navin Fluorine generated 34.24% of its revenue from the Indian market. The remaining 65.76% of its revenue came from international markets. Now, let's look at the management of Navin Fluorine. Mr. Vishad P. Mafatlal is the executive chairman of Navin Fluorine. He has over 26 years of experience in the textiles and chemicals industry. Mr. Mafatlal holds a Bachelor of Science degree in economics from the University of Pennsylvania's Wharton School. He is also the chairman of Sri Sadguru Seva Sangh Trust, a social and charitable trust providing services in education and healthcare to rural masses. Mr. Mohan M. Nambiar is a non-executive director of Navin Fluorine. He is an experienced professional with over 60 years of experience in various industries. Mr. Nambiar has held positions such as president, chairman, and member of institutions such as the Cement Manufacturers Association, National Council for Cement Industry, the Associated Chamber of Commerce and Industry of India, and the Bombay Chamber of Commerce. He holds a degree in commerce and is a member of the Institute of Chartered Accountants of India. Mr. Sudhir RDO is a non-executive director of Navin Fluorine. He has 44 years of association with Arvind Mafatlal Group, AMG. Mr. Dio has headed multiple mandates of the business including manufacturing, technology, research, strategy, marketing and supply chain. He is an expert in ESG and sustainability, focusing on implementation to elevate business value. He holds an M.Tech in chemical engineering from IIT Kanpur. Let's take a look at the shareholding of Navin Fluorine. The promoters are the largest shareholders of Navin Fluorine with a holding of 28.81%. Mutual funds hold 15.58% of the shares. Foreign institutional investors hold 15.57% of the shares. The public holds 27.01% of the shares. Other institutions include several investors, such as banks and insurance companies. They hold 13.03% of the shares. Let's look at the cost structure of Navin Fluorine. The cost of materials is the largest component of Navin Fluorine's cost structure, accounting for 43.69% of the total costs. Employee benefit expenses account for 13.84%. Other expenses account for 21.57% of the total costs. Now, let's focus on the financials of Navin Fluorine. The table shows that the company's net sales have grown steadily from 591.51 crores in the financial year 2015 to 2065.01 crores in the financial year 2024 at a CAGR of 13.32%. The company's profit after tax has also grown steadily from 58.25 crores in the financial year 2015 to 270.51 crores in the financial year 2024 at a CAGR of 16.6%. At last, the company's return on equity has increased from 9.91% in the financial year 2015 to 11.35% in the financial year 2024. Let's now turn to the management commentaries to get a better understanding of the company's performance. The company's revenue for FY24 declined by 0.6% to 2,065 crore rupees, while its operating EBITDA declined by 28% year-over-year to 398.3 crore rupees. The company's operating EBITDA margin dropped by 720 basis points year-over-year to 19.3%. The HPP and specialty business provided robust performance in FY24 with 7.8% and 14.1% year-over-year growth, respectively, despite global headwinds, while the CDMO business lagged in FY24 as it declined by 41.5% year-over-year. Now, let's move on to the management commentaries for specialty chemical business. In Q4 FY24, the vertical reported a 26% year-over-year increase in sales to 257 crore rupees. Due to higher utilization and the addition of new molecules, 1 molecule at the Dahej plant and 2 molecules at the Surat plant. The agro-specialty capex done earlier initiated a chemical charge while firm orders are in place for the capacity. Additionally, a capex of 30 crore rupees has been done for the development of a new capability in Surat, which will generate revenue in FY25. Now, let's move on to the management commentaries for high-performance products business. In Q4 FY24, this vertical reported a year-over-year sales increase of 3% to 297 crore rupees, which also reflects sales from the commissioned R32 capacity. However, this increase was offset by lower export realization and reduced HFO sales. The refrigerant gas market has started recovering, while operations at the HFO plant, which were previously facing issues, have stabilized and provided higher sales than in the previous 3 quarters. The AHF, anhydrous hydrofluoric acid, capex is on schedule to be commissioned by late FY25 or early FY26. Further, the additional R32 capacity, with a capex of 84 crore rupees, is also on schedule and expected to be commissioned by February 2025. Now, let's move on to the management commentaries for CDMO business. In Q4 FY24, this vertical reported a decline of 78% in sales to 48 rupees crossing, which the company attributed to the deferral of molecules. Order visibility from existing MSA with European CDMO major for FY25 stands at 50% with orders in hand. Additionally, a new customer, a UK pharma major, has been added by the company. Purchase orders are in hand for 2 RSMs for delivery in CY25 for a drug recently approved by the FDA for commercial launch for a US major. The board approved a CGMP4 capex amounting to 288 crore rupees. Phase 1 outlay of 160 crore rupees. On track to commission by the end of CY2025. That's all for today. I hope you found this video helpful. If so, please give it a like and subscribe to our channel for more research-based financial content and click the bell icon for potential multi-bagger stocks. In the comments below, let us know what topics you'd like us to cover in future videos. Thanks for watching.